So crazy times in the real estate market now is we have
Yeah.
Trump's mentioning this 50-year mortgage. He's addressing that.
Yeah. Well, we got an affordability problem. I think it's a heck of an idea.
Yeah, it's going to be interesting. At first, Trump tweets a lot of things, so we weren't sure. But now the guy from Pulte is saying they're working on it. So
Pulte, it's on his staff. His last name is a home builder. So, yeah, this is a big deal.
Yeah.
It's going to lower monthly payments. And Trump just stepped over the Fed.
Yeah, he really did.
He's like, I don't need you to really agree with me on the lowering of the rates. By the way, they're supposed to be disconnected anyway. So, but it is interesting. And if you get both, it's really gonna make the single family housing market get going.
Well, on the other hand, you have Jamie Dimon and a lot of the banks propositioning Trump to ease on regulations, so allow them to not have as much reserves, and also to streamline the paperwork, whatever that means.
These are finance guys. It'd be interesting to see what that means, right? But I can tell you what I think it means. It means they want to get more people in more debt.
Mm-hmm. But they are saying because of this streamlining and not having as much reserves, they can lower their rates about 0.5 point.
Who's they?
The banks.
Oh, well, yeah.
Well, and Trump's a deal man, right? So he is, to your point, he's working directly with the banks, and he's working directly with trying to address lending as well, the loans, and trying to see what he can do outside of just interest rate.
Right. By the way, this is all good. It's going to jack the economy in a good way. Obviously, I think that it'll be hard for the landlord, harder if the 50-year passes and the rates go down and all that, because more people will shift from renter over to homeowner.
Right, because you always say back in the Bush era when everybody, they wanted everybody in a house, that actually negatively affected rentals because people would buy a house.
Yeah, where does a home builder go get their buyer from a renter?
You still could have an issue with that down payment, though. That's still going to be quite a hurdle because it's significant.
That could be the next thing they tackle, right? Like, so maybe you can get that money from your parents' retirement plan or something like that. That'll be very, very interesting to see how gifting comes out around all this too.
Right, because the boomers are the ones with the money to help the people.
That money's where's it going to go anyway? It's going to eventually make it to the kids' estate. Might as well give it to them early for a down payment. Now, I'm, of course, making an assumption, but it is going to be very interesting. The baby boomers have a tremendous amount of wealth that's actually passing over now, right? Kids are making a lot of money that the baby boomers painfully got, I would say. And that's going to be a huge source of wealth in the next 20 years.
Yeah. I mean, you're definitely seeing more of a generational wealth, coming through now, because where a lot of people that I'm helping buy that are younger have help from their parents for the down payment, because what, Gen Z or what, 25-year-old has $100 and some $1,000.
Yeah. You should be able to do that. If I want to do a cash out refi on my house and I pulled several $100,000 out, why couldn't I be able to give $100,000 to my son to go buy a home?
Right.
Like it's a restriction. I wouldn't be surprised if you start to see that.
Is it a restriction though with gifting?
I think there's some. I could be wrong, but I believe that there are some restrictions around gifting. But I very well could be wrong on this. But the point is there's a lot of money floating around, and I think it should be redirected. I'd have to consult with a tax person on that issue.
Yeah, I mean, I know you can't gift on an investment property, and there might be caps before you have to pay tax on a gift and things like that. So.
Well, for sure. If you're giving money to somebody, they got to report it as income, right?
Yep. And today on our show, we have Stephen Rice.
Yeah.
Yeah, he's one of the partners at VRAC Capital out of Ohio, where I'm from.
Yep.
And this is a great conversation, for those of you that are in multifamily or interested in multifamily, because they really go through, him and Ken, how raising capital has changed, how operations is so important now, and why. Because you hear that all the time, operations is important now. Well, why and what does that mean? And why you can't just easily outsource that.
And they just bought a 350 unit portfolio for $50,000 a door. And for those of you who know this business, that is insanely cheap, because they had a relationship with the bank. And I think that's the most important thing. And you don't get those kinds of deals unless you actually have a sound operational background management company and can do that. Like you can't just get those deals. They're looking at, can't, if I hand it to you, can you actually even pull it off? So it's a really, really, really good interview we just had.
And one of the interesting things I thought from the interview too was talking about how the S&P 500 and the jobs numbers always kind of went in tandem, and they were linear. But ever since ChatGPT came out, you have the S&P 500 going up and you have the job numbers going down. And this is a very, it's different than it normally is.
Yeah. So that was an interesting perspective he had too. Everybody follows different things, and that was a pretty eye-opening moment for me. I'm gonna have to dig in on that.
Yep. So enjoy.
See you guys.
So Steve, you're coming to us from Ohio, where it is
It's
snowing.
Yeah.
Yeah. Oh, yeah. First snow of the year. So,
No kidding. So there's a lot of people buying in the Midwest, right? You guys are right smack there. Danille's from there. And it's this market that everybody's talking about. There's a lot of new players in that market. So what's happening in the Midwest? I know you guys are not just in the Midwest.
yeah. Well, I mean, it's affordable, number one. So that's and Cincinnati is our primary market we focus on, and Columbus and Indianapolis. But yeah, we're starting to see there's a lot of opportunity here still for rent growth. Our rents are still the cheapest in terms of the national average, and we look at it as a lot of opportunity. There's not that much distress happening, right? But we're starting to actually see some. So we actually just bought a deal recently that was going into foreclosure, and so we're starting to see a lot of that. We're starting to see a lot of distress actually in Midwest. There was a lot of people that got speculative in 21 and 22.
Yeah, well, I know.
So
it's great that we're starting to see those. I do want to talk about those in a minute, but where are rents right now in the Midwest? Like, what does a renter pay?
yeah, like 1,500.
Was that for a 2 or a 1?
Two bedroom, quality B class housing, 1,500. It's going to be 2,000 for a class.
I know you guys have been kind of there. Well, you have been there for a while. You've been in business a while. I just all full disclosure, I've invested in some of your deals just to let everybody know. That's how we know these guys, and obviously they're part of our mastermind as well. But where have you seen rents go like over the last few years? They're going up. In a lot of areas it's flat, negative, lots of concessions. What's going on in your markets?
Yeah, I mean, it's there's not too many concessions. We're not really overbuilt here. From where rents were at. I mean, it's funny. Looking back. I mean, I remember leasing apartments at like $800 for 2 bedroom, like in 2013. So we've come far away, and it's funny. It's funny to see, but it's and I think there's still room to run as well with the rents here. So we're
in 10 years it's doubled then. More.
Yeah, oh yeah.
Like, that's a fairly significant, and I think that's important to know. You guys were there early on. You've had incredible success there. Is there still a lot of population growth to the Midwest, and what's going on with the buyers?
Yeah, we're in 21 and 22. There was a lot of out of town buyers. That's actually when we exited out of a few of our Class C projects. But yeah, we're still. I mean, we're still net positive growth. It's not like Texas or Florida or Arizona, right? But we're still net positive, and I actually think over time that's gonna increase the percentage. So it's flat to positive right now, but over time, I think as things get less affordable over time, and people are going to be looking, and we have lots of jobs here. I mean, that's the thing. Like Ohio has, I think we're the fourth largest populated state, right? And we have just a lot of old money companies, P&G, and jobs here. So that's something that provides a very stable environment to invest in. We're not the boom and bust city or state, but it's just stable growth over time, cash flow. We invest for cash flow, right? So
yeah,
something that you've always taught, right? So it's and we're cash flow investors.
So Trump just announced wanting to do, a 50-year mortgage. I don't know if you heard about that, but it's a big thing now. Pulte just weighed in that they're working on it with him. Do you see that affecting anything in your market because of the affordability, mortgage payment to rent payment?
Yeah, I mean, I actually think it was funny because I texted Matt and Robbie about this last night. I was like, Matt and Robbie are my two partners, so I think it could. I mean, you might have a situation like '08 again, or, prior to 2006, 2007, where, and who knows, but you might have a situation where home buying starts to pick up and then rents kind of slow down,
Yeah.
right?
Mhm.
And then you got to adjust, right? So if you're over leveraged, right, you're betting on rents just to continue to go up, which they could, but you got to combat all that. And one way that one way we structure our deals is lower leverage. I mean, we just stay at lower leverage. So that's one way that we're kind of safeguarding our portfolio from either way it might go. Right. So
I think this is an important point. Like a lot of times people that are getting into real estate or think about real estate, they think of how they can do the 0 down or 10% or 5% down or something like that.
Yep.
That's not the best strategy. And I know like Ross and I, as you know, we're at under 60% loan to value, in some cases we're way below that, on stuff that we've owned a while. So what that means is that we got 40% at least of equity. And so the market values can come down and our payments are fixed. So what Steve's saying is that you can be fairly vacant and still pay your bills, right? I think that's kind of what we're saying.
Yeah, absolutely. Absolutely. We're about the same. We're at about 60 as well. Right. So yeah, I totally agree. I mean, if rents come down, you know, uh, jobs are being lost and different, you want to still be in a position to where you can refinance, right? Like you don't want to be in a position where, oh goodness, now I got to bring money to close or, whatever situation you might be in. You always want to be able to operate, right? And save the property and save the tenants, right? And save look after your investors' money.
You get through downturns with low leverage, I guess is probably the way to say it.
Well, and I think what's really interesting is on top of the 50-year, Jamie Dimon and the banks are propositioning Trump to, ease on the paperwork and let them hold less reserves. Yeah. So, and Trump said he's working on them with that as well. So to your point, I mean, between the two of those, you are kind of prepping for a mass home buying situation. The only difference perhaps would be, the 0% down mortgages that were allowed back in, 06, 07. Those necessarily wouldn't be back. So people probably are going to still have to deal with the down payment of some kind, but it is going to promote more people getting into homes.
Yep. No, I totally agree. And then the $2,000 tariff dividend. Did you guys see that?
No, what's
No.
that?
So I guess he wants to send out a dividend
stimmy check
from it's like a stimulus check, right? So $2,000 dollars to everyone, right? So what is that going to do, right? They're going to push inflation.
Oh my gosh!
Yeah,
So
yeah.
that's gonna increase the savings rate for a while, get more people in debt, and then it'll be just like what happened.
What's interesting though about 05, 06, 07 is we didn't really have inflation like we do now though. So that is a difference too in what's happening.
But when you were in college, like if you got $2,000 in your mailbox, what would you do?
Well, I did. Obama sent me $600.
Okay, what's he doing it? That's what I want to know.
I just added it to my monthly of bills I needed to pay.
Gosh, I would have Cabo. Like,
I was a teacher. I was like, oh, thank God, some help here because I was drowning in my expenses.
I guess it depends on your age and the situation you're in, right?
Yeah.
It's like a tax refund. Like, I always laugh at if you like everybody knows when you obviously pay taxes and you get those refunds and man, there's sharks, there's marketing or PR agencies that are trying to get that cash, spend here, do this, right? So
Oh yeah.
You're going to have a little bit of that.
Yep.
That's interesting. I hadn't heard that.
Yeah, it was on X the other day. I was, but well, yeah. So I don't know if it's going to happen, but you know how Trump is. He's always
Yeah.
Yeah, he flies off at the handle. I didn't actually believe the 50-year mortgage until Pulte now came out and said that they're working with Trump on it. So that gives it a little bit more credibility.
I actually think it's going to happen.
yeah.
I mean, I really believe it's going to happen. We did the calculations. It lowers the monthly using the exact same term or not the exact same term, the exact same rate and the exact same down payment. It lowers it by almost $300.
Yeah. So I mean that's just the difference. For a lot of people.
Right? It is.
It's interesting too if it'll stay the same rate though, because you do have a difference in rate between a 15 and a 30.
It does. You know what it does though? You know where it puts that mortgage for the $415,000 house at 6.2%. It puts the mortgage payment in the 1,700 range, which is smack dab right where you are and I am for our rents, right?
Yeah.
I mean, what it does is it takes right now we're heading toward a renter nation because they can't afford a home, but now it moves that needle back to compete against the landlord.
Yeah, that's true. That's true. I mean, so yeah, I mean, that's why you gotta be looking at all this stuff.
Right, you're at 60% leverage.
Yeah.
But it was funny because on our live, we're talking and there's a bunch of boomers commenting like a 50-year mortgage is ridiculous. I would never do that, et cetera, et cetera. But, they're not in the same position as these Gen Z and
only people that own a home would say.
Exactly.
They bought their house for like 20,000 and it's worth $1 million today. So
yeah, exactly.
It is like a tale of two worlds, though. You got the single family folks, and then you got us, let's say on the commercial side, office, multifamily, retail, industrial. It is an extremely different world where you've got affordability problems in the single family market. You got, you can't make anything pencil financially if you're trying to buy it, rent it.
Yep.
Whereas on let's jump right in. You made the buy of the year, man. Like you guys just crushed it on a 350 unit portfolio, right?
Yes.
Now walk us through that. How'd you find it? How long did it take to buy it?
Yeah, so we actually got I guess we got this in April of this year, and it was going into foreclosure. The city was taking it back. It was run by an out of town owner, and he just kind of let it go. And it was one of those guys that grew really fast in 21, 22, took on a ton of investor capital, and they a local broker brought us the deal. Matt brought it to Matt actually. Matt's my business partner, and he focuses on his main focus is acquisitions. So Matt's been working on this deal for since April, and we had to negotiate with the city. Now the city already knew who we were, so we took over a similar portfolio in 2020. It was a 200 unit portfolio. It was run by another out of town person. Just let it go, and the bank actually called us up, and we took it all over, right? And they gave us $1 million. So this was in 2020, and the city of Cincinnati actually, once we kind of stepped in, and they knew that we had this project that we just closed on in our control. They actually backed off the foreclosure, and they said, okay, we want you guys to own this because we know it's going to get taken care of. Right. So it was really it was really just a huge blessing that we, had the track record, the timing, the relationship with the broker, and, in real estate, it's what it is. It's time and sometimes. And
you guys, how long have you been in business again?
2013.
So I want to just really make an emphasis here. You guys are a 12-year overnight success, right?
Yeah.
Yeah. You got the heck beat out of you for years, like all of us. And I just really want to say, once you get into the game, these are the kinds of things that do happen. This is, is it insider trading, or is it just, is it doing the right thing? And because if you get a blessing from the city of Cincinnati, how are they involved here, by the way?
So they were trying to take the property and put it into receivership.
Oh, okay.
It's a 3 property portfolio, and the bank was trying to not, we came in there, we were able to negotiate, we were able we knew the seller's lender, so we were able to discuss it with them, and we just got everybody on the same page and working towards a successful close, and we closed a week later than we projected, but we closed.
Right. Yeah. These are relationships that you guys built, planted, grew, watered. That are, and that's where you're heading next. But what's fascinating is the price per unit. Why don't you talk that through, and how below replacement cost is that?
Oh goodness. I mean, it's probably 30 to 40, or it's probably, I guess it's 70% below replacement cost. So 50 a door roughly. Now it is Class C. We grew up on Class C, right? So we cut our teeth on tougher assets. So 50 a door. We had just sold another property that we purchased in 21 for 50 a door over in this area. And we sold that one for almost 105,000 a unit. So, and some of these properties are already kind of renovated, right? So you're doing some light renovations on two of the properties, and then one of the properties actually needs some heavy renovation. So, we think the end value on this is probably 120-ish, 130.
There you guys go. That's how you make money in this business. How would you like that?
Yeah, that would be nice.
If I buy something for 50 a door and know after you buy it, when you fix it, it's going to be worth 100 a quarter.
But I have a question about that. So they couldn't make it work. So how can you explain how you can make it work and what you're doing to make it work?
Yeah, that's a great question. So it comes down to operations. Like, I mean, Ken, you say this all the time, right? It's operations. I mean, either if you have a third party that's going to manage it, right? Then you need to be on that third party all the time, right? But we manage in-house. We manage our construction in-house. We're going to have guys there every single day. And C property, it's more intense management, right? So you got to be on it, right?
Mm-hmm.
So the difference is that previous owner, I don't even think he showed up once to his properties. Like he would hire managers and just hope that it was getting done, right? And he's losing a lot of other properties too. So we're in,
just follow him around, man. Like, this is something that I don't think people realize.
That he loves Matt, by the way. He loves Matt. So.
This is how things go. Like what happens is, people raise capital, they go out and buy stuff, and they don't know how they just think it's going to go up and it's going to magically manage itself. It's going to magically produce cash flow. This is actually the undercurrent that's going on right now across the United States, right?
Yeah. Oh, yeah.
But before we get into that, can you more in depth explain like what wasn't getting done, or like, if people are listening and they're trying to understand like what you're going to do different?
Fair point.
So there's just city work orders that were, people started reporting, mold and really bad situations, right? And that stuff gets on the news, right? I think it's 50% occupied when we officially took it over, and
it's like a cancer. What happens is that you stop taking care of the residents, you stop doing the maintenance, and then what happens is they start moving out, and then you start robbing from other units to fix other units, and you run out of money, and pretty soon your occupancy is so bad, and your income's low, and then all of a sudden the income doesn't even cover your operating expenses plus your debt, and then eventually you become default on the loan, and then you get foreclosed, and so it's a long, drawn out process. Right.
Yeah. Oh yeah. Yeah. There was a bunch of liens on the property that we actually had to negotiate and get satisfied. Right. So, and then there was some people that waited too long to put their lien on the property because this guy just didn't pay anybody. Like he would get, evict tenants or get contractors. And not pay them. And then, so it was just a really bad situation for people who worked on the property, for the residents. And, you just got to go in there and grab the bull by the horns and start managing, right? You got to
take care of your people.
Well,
the people that pay, the residents pay everything. So
yeah, exactly.
They're the most important.
Well, and I think this is happening all over the country because our friends own a plumbing company, and she was telling me that there's so many multifamily units that just have not paid them.
Yeah,
You know,
it's absolutely true.
and that's in Arizona. So,
and by the way, I do want to point out that this is not something that happens quickly. This is a poor philosophy, a poor management. This probably started 3 years ago, I would guess. It's just, first people start moving out, then you can't fill them up, then you stop paying vendors, then you get liens. Like it's a 2 or 3 year process, right?
I totally agree. I mean, it just starts to spiral. You don't pay one person, and then your property starts to get a bad reputation. Google reviews start showing up. I mean, it can just start spiraling out of control, right? And that's why, when people say passive income, well, I mean, I don't know if it might be passive for, the LP investors.
Yeah. Right now it's a hockey game for you, you get checked on the boards, but it's actually, to your point, this is the most exciting. This is why people are like, why are you buying right now? Like, things are so bad. This is it. Like, I bought, I bought a 680 unit building in San Antonio in the last cycle that was 50% vacant, almost exact, from the bank. And the first 2 years are rough, right? It's hard.
Oh, it is. It is. I mean, you got to go in, rebrand the property.
Yep.
You got to get all the knuckleheads out, right?
Yep.
And that are causing issues. And I mean, we've seen a lot in property management. So.
Yeah. And by the way, that is here's, you want to make a case for property management, this is it. Because what happens is, in this next cycle, these lenders, they're like, oh, they were just a TikTok influencer, raised a bunch of money. They have no idea when they walk on a property if it's doing it or not. They're going to rip that. The lender's going to take that property from that person because they don't know what the heck they're doing, and they're going to move it to a group like yours or mine. Like, this is where property management is going through a wake up call right now. Good ones, at least. And it is our time. It's the hardest time, but it's our time, right?
Yeah, I totally agree. We actually, a lender that we've done a lot of business with, called the president of the bank, called us up, and then just invited us to his office to talk. We had no idea what we were going to go in there and talk about. And the whole conversation was geared around wanting to do more deals with us. And they are only going to lend to the operators that they have trust and have actually had success. Right. So we're starting to see some of that talk. It's all about, working hard, putting your head down, building a good reputation. Right. And, that's, speaking to your comment earlier, I mean, it does take time, and that's what starts to happen. Right. Is you get invites from lenders, you get these type of deals, and you just got to push through. Right.
Yep. And, what we just moved out of was the decade of the capital raiser. Right. And now we're moving into the decade of the operator.
The property manager. Yep.
The property manager. I mean, because to your point, I've been through this cycle once, and, back in 2008, when a bank president calls you, literally they're freaking out because they're like, okay, I'm only going to lend to people that know how to run these things. Right. And so that's a really good sign. Right.
Yeah.
The other thing I just wanted, before we jump off of this, somebody somewhere lost a lot of money here.
Oh yeah.
Like we can't just brush over that. Like, there was, I don't know the number, probably 10, 15, $20 million of equity that was put down on this deal, like
Absolutely.
3, 4, 5 years ago. Right.
Yeah. Oh yeah. He bought it for what we're going to sell it for. Right.
Yeah, so he bought it for $125. So that's another 15, call it $15 million you guys owe turn that right. In 2 years plus, you'll have increased the value by $15 million.
Yeah, exactly. Yeah. So it's it's sad. I mean, I hate to see it because it does kind of, give syndicators or, investors like us like a bad name sometimes. But at the same point, like those investors, like that, I mean, those people's retirement and,
it's horrible. And
it's horrible.
I think that's what really is going to get exposed next year is, the capital raising got so easy that people were jumping aboard with all kinds of folks and that know quite how to operate.
So that brings us to a good question, though, is how has capital raising shifted, or how is it going to shift moving forward that's different than when it was a couple years ago?
What do you think, Steve?
Oh man, that's such a good question. I guess, looking back to 22, 2022 and I mean, that was a time when everybody was raising cash for a deal, pref, maxing out equity, right? Or maxing out the debt. I mean, I I think going forward, people are. I think they're going to have to raise money more so on cash flow than like these IRR or 2, 3, 4, 5 year projections. Like, a lot of these groups. Well, one thing I realized was all these groups that have raised money, they'll project a 25% IRR, right? And it's like, or a 20, and I'm like,
explain what an IRR is to the audience.
It's just the time weighted return, or it's your annualized time weighted return, right?
Okay.
So
it's called the internal rate of return.
Yeah, internal rate of return, right? Which it really doesn't mean anything until you sell.
Right.
But like the two things we look at is equity multiple and cash on cash. I mean, that's just what we look at, right? But it's really interesting because a lot of these, financial institute, a lot of the institutional capital, it will look at these investments and be, like 25% IRR, but then they return 9% IRR or nothing, right? And it's like, I mean, like what is going on here? Like, like, and then you underwrite the deal yourself, and I can't in good conscience put that on paper and present that to an investor. I mean, it's almost like lying, right? So it's I don't know exactly how it's going to change, but it's I think people are going to have to start thinking more cash flow instead of equity.
Always. Here's the other interesting thing that I just want to point out. I just thought of when a property's 50% vacant, everyone has a problem. Like the bank has a problem. And why do they have a problem? They have a problem because they can't lend on it. They're not going to lend on a 50% vacant property. So that's a problem, right? Or if you don't have the sophistication, you're not going to buy a 50% vacant property, right? So so this is good. I mean, if you're us, right? Because you don't have the big institutions buying these because they're 50% vacant. You don't have the financing because it's 50% vacant. So what you have is you have the small guys like us that are, we're a speedboat and they're the Titanic, and we're like motoring around and fixing people's problems. That's why they got the call from the bank president, because they're the bank has a problem. Okay. And so to your point, they're basically handing you the property and then giving you the money to fix it. Now, I know that sounds bizarre. I mean, that's not exactly how this deal went down, but the point is that is where it's headed, right?
Yeah. Oh no, I totally agree. I mean, it's going to be how well can you operate? It's not going to be like it's not going to be telling your investors, oh, our property manager isn't managing correctly, right? Or not doing a good job of managing. So then they switch property managers, right? And you see that. Yeah.
Danille's question, listen to this one. How do you raise money when you're 50% vacant?
Yeah.
Seriously. Like, think about that question for a second. If you're a TikTok raiser, you're not because there's no cash flow. The reason there's no cash flow is because the bank owns it, right? That's how the bank got it, because there's no cash flow. So how do you raise money on something that's 50% vacant? And there's a ton of lessons here, right? And this is the time to buy if you know what the heck you're doing.
Mm-hmm.
Right.
Well, and the banks know that, which is why they're particular on
why they're calling Steve, Matt, and Robbie into their office and saying, can you help us? This could be the strongest time for your guys' relationship moving forward, because you're going to get more calls like this.
Yeah.
So let's talk about rent growth. With unemployment ticking up, are you still anticipating rent growth, or do you expect a softening or flattening of rents?
Oh goodness. I mean, I see where it can continue to grow. Okay. But there's just so many headwinds between AI. I mean, I saw a chart the other day. Unemployment and employment and S&P have been correlated for years. Then the launch of ChatGPT, and now boom, they broke correlation. It's just the S&P continues to go up, and unemployment is rising. Right, so it's like there's so many unknowns in the future. One of the main things, this is something that me, Matt, and Robbie just talked about the other day. It's like, okay, our number one thing we can do is stay at healthy loan to values, right? Like that's going to give us a strong
and fixed rate.
Yeah, fixed rate and fixing our rates, right?
Yep.
And not being in bridge debt and different things, right? So it's an uncertain time. I mean, but again, I see it potentially going, continuing to go, right? I mean, heck, if everybody gets a stimulus check for $2,000, then are we going to go back into another inflationary situation again? So it's all very interesting right now, and we're trying to play it both ways. Like, hey, let's be in a position for interest rates to, if you're at a 50% loan to value, right, and your rates are fixed, and let's say rents blow up again and interest rates have to go up to combat that inflation, well, you're going to be making more cash flow, and you're going to be your rates fixed, right? So you're good, right? And then if you're at 50% loan to value and rental rates go down, right, and your property value goes down, expenses go up, let's say you lose 30% or whatever of the value of your asset, well, you can still refinance if you need to into those lower rates, right? So being at healthy debt levels, we feel, is like the number one thing we can do to protect ourselves and, also gain some upside, right? So hopefully that answers your
But
yeah.
the worst thing you could do is project rent growth in 26. Like,
yeah.
If you get it, great, but you shouldn't, right? And maybe in some markets, but they're rare. And let's don't forget there was 506,000 units delivered in the last 12 months in the nation. And there's a lot right now. There's a multifamily supply problem, right? Mm-hmm. It's a renter. It's time for the renter right now. So and so here's the other thing. On the property that Steve, Robbie, and Matt just bought, there's no rent growth. All you're trying to do is get renters. Mm-hmm. You know what I mean? Let's just fill it up. Right? Like the last thing on your mind is rent growth, and that's year 1 and 2. And then, so maybe in year 3, when you stabilize and get to, 93, 94%, maybe you look at that at that time. And then from there, it could be another year to 2 years before you actually hit market. So these are, if you're buying something that's broken, there's no rent growth at all. And this is why it's really, really hard. That's why your question was so good, Danille, because how do you raise money when there's no rent growth? Expenses are going up, cap rates are flat or up, which means values are, not projected to, go anywhere soon. And you're unwinding problems, you're unwinding equity problems and debt problems. And it's the hardest time to raise money right now because But this is the time to actually do it, right?
Yeah.
I went through this in 08, 9, and 10. Like it,
Yeah.
when there's blood in the streets,
Yeah. That's
it's
when to go in.
it's time to be an operator.
Yeah. No, I totally agree. Yeah. It's, you know, yeah, I totally agree. I mean, and how do you raise money? It's we just have the track record, right? We have the experience of dealing with these type of assets, and like if we did not have experience with this, we actually had a few investors back out, right? Like, oh, we don't like the C property, play right now, but we know what we got, and our investors trust us, right? Like we built that trust, and that takes a long time. Like we could not have done that,
When you
early on.
started. Yeah.
Yeah. There's, so
And that's kind of the point.
So we're going to have some rapid fire. Josh likes these for YouTube. So
awesome.
I'm just going to ask you the question and you give an answer.
Yeah.
What do you think distinguishes great real estate partners from good ones?
Values.
Oh, you can kind of go in a little more detail.
So core values. Me, Matt, and Robbie, great partnership. We're like brothers. Our core values are the same, right? We have different personalities, we complement each other, but our core values are the same, right? And our three core values for our company are ownership, stewardship, and fellowship, right? That's really who we are. And if your core values are aligned, then everything else, you can work through a lot. So I would say that.
What's the most overlooked metric you think investors should be tracking in 2025?
Oh man. Most overlooked metric. I think I just think does the property cash flow.
Yeah.
Right.
I agree with you.
Can you cover your your expenses and everything? I mean, we're buying a mobile home park right now, and we looked at we actually it's funny. So we told the bank, we said, hey, we actually don't want that much leverage. We want to go in at 40% leverage, so we're cash flowing day one, right? We'll raise the more equity, right? And we just want to stay. We want to cash flow on this. This is a deal. We've never done mobile home parks, right? We want to stay conservative on this, and that's why we're good. So the bank was like, man, I've never had an operator ask me.
It's the way it's done, though. That is the way it's done. That's smart.
Yeah. So so yeah, I think cash flow.
Yeah.
Last one. What's one mistake or learning experience from a past deal that has most shaped how you invest today?
Oh man, so we got caught up in the 2022 hype as well. So not as bad though. I remember we were talking to Ken, and we were like, Ken, like, man, like what are we missing? Like everybody's buying these deals, and like what are we missing here? Like, and I remember you telling him to stick with your criteria, and and there was a deal we bought as like 100 units in really good areas. Like long term we're going to be fine, but it was a time where the interest rates blew up on us, and we were under contract, and we actually closed with a much higher rate than what we anticipated, and we 100% should have retraded. But the reason we didn't was because there was a whole line of people wanting that asset, and we're like, man, like, but we should have retraded. So I mean, that's what we should have done. And now it's still cash flowing. It's great. We're actually getting ready to refinance that right now. So we're gonna lower our rate from 6.5 to 5-ish, right? So we're gonna increase cash flow, and we'll increase the investor cash on cash. But yeah, just little lessons like that, like everybody's buying, and you gotta, like, you feel like you just gotta get a deal, right? It's just don't get caught up in that, right?
Yep, the FOMO of it all.
Really wise. You have to go through it to see it, right?
Yeah. So it's been a great experience, right? So
let's end this by chatting about the collective, because you, Robbie, and Matt have been collective members since the beginning. And I want to get into, why you feel it's beneficial and what the collective is as well.
man, the collective has been absolutely amazing for us. I think weren't we the first members to join?
Oh, yeah, but you guys in Miami.
Right? Yeah, in Miami at Rebel Capitalist. So that was, it's just been amazing. So Ken has been fantastic. You've been just such a great, uh, mentor to us. Really, I mean, and just a great advisor, right? I mean, you've let us fly out and hang out with your staff, and it's just like an open book. I mean, you're so generous with your knowledge and your time. That's the way everybody is in that group. The partners, Jason and George, and the real estate guys. It's truly an amazing group. And one of the main things that changed our business was EOS. And I remember when we first joined, you said it's the first thing you told us, like, you guys, you got to implement EOS. And we, it took us, I don't know why it took us so long to actually pull the trigger, but we did. And that's something that we just wouldn't have gotten if we didn't join the collective. And I know it's been game changing for you. It's been game changing for us. I mean, we're so much more proactive now in our operations instead of reactive, just because of EOS. Like, EOS has allowed us to become better operators, right? So, but we got to see how you run it, right? And that's the insider information. That's the collective value, is that knowledge, and everybody else, like, just learning from. We built so many great relationships now, and it's just amazing to just have people that you can bounce stuff off of, and everybody's just trying to get to the same place. We're trying to navigate all this uncertainty, right? And it's so amazing to have a group like that. So, really happy you guys created it. So
yeah, thank you. Yeah,
yep.
The quality of the members is incredible. Like I think people, especially business owners, it's lonely.
Yeah,
like
it is.
No, there's can't really talk to your employees, right? Who do you talk to, really? To try to figure out how to be better, get better, and we all have a number of issues, right? Yeah. And so just being together is, if you're open to be able to just open the kimono and put it on the table and just say, this is what I'm challenged with. You can move mountains.
Oh yeah. Yeah. I mean, one conversation can just boom, set you off in a whole, direction that'll change your life, change your business, right? And being in that group is like that. So we're very thankful for.
I can't wait to see you the next one.
Yeah, January, right? Is it January?
January at the Broadmoor in Colorado Springs. Bring your jacket. It's cold, but it's we set goals, right? 2 days of goal setting for the year, for personally, business, family. Except Danille's roping me tonight. She's like, hey, like, tonight we're setting our travel schedule and our goals for 26. I said, okay, whatever you say.
Awesome. Well, Steve, how can people get a hold of you?
Oh man. Robbie is the Twitter celebrity. But you can find us at vrec.com, vrec.com. That's our company. And I'm also on Twitter as well. So Stephen M. Rice 17. Robbie, my business partner, Robbie, puts out a lot of great content. He's always sharing what we're doing operationally and different things. So go follow him, Robbie Hendricks. And, we're just, normal guys, Midwest, trying to grow a real estate company. So,
well, it's working. Yeah. Congrats on everything, man, too. Seriously.
Thank you. Thank you, guys.
Yeah. All right, Steve. We'll chat with you soon.
Yep.
Awesome.
Awesome.
Thanks, dude. That was fun.
Yeah, man. I always enjoy talking shop.
Yeah, I know. Well, can't wait to see you guys soon. And
Yeah.
congrats on that deal, man. I was like, damn, we're in the middle of a bunch of raises, including this, the billboard stuff I got going.
Oh yeah, Robbie was telling me about that. Yeah.
Yeah, but also, we just got another deal in Vegas. We're flying up next week to take a look at it. We're in due diligence, and so I got, unfortunately, well, my dry powder is not so dry as pouring it into our own stuff.
Yeah. Oh yeah. 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 It looks like you're getting some really great assets.
We are. Yep.
Oh,
It's you said there's a window, right?
Yeah. Yeah. Yep. Yeah. We just got another 180, or we got another 190 unit in Columbus.
Nice.
Under contract, and then we have a 180 unit. And the 180 unit in Cincinnati is, well, man, it's Matt's Matt's the one, man. Matt likes to push. And I'm like, man, we gotta, we gotta get things organized.
Worked. Yeah, I know.
That's in their company. That's
I'm the gas and Ross is the brakes.
Yeah.
Need both.
Yeah, you do. And Robbie's usually the referee in the middle.
Yeah. Perfect. Yeah. I know. It's actually the perfect partnership because I when Ross puts his hand up and says no more, I know he means no more,
That's so funny.
It's true. He always says that Ross is the brakes and he's the air.
Yeah. 100%. He's like, I think we've had enough. I was like, okay.
Yeah. Oh yeah. Yeah. Matt, Robbie and I will have the same conversation with Matt. I'm like, okay, dude, like, let's pump the brakes.
Yep. That's the funniest thing. That's the power of a great partnership.
Oh yeah. There's mutual respect.
You can't have two gas because then you're not,
or two brakes,
and you can't have two brakes because you'll never get anywhere. So you have to have both.
Yeah, you can't. Yeah, it's we took those visionary integrator assessment for EOS, and we all three of us scored high on visionary, but I was the only one that scored high on integrator. So I'm the integrator in our business. So I oversee all the operations now, and then Robbie's capital and Matt's acquisitions. And Matt loves doing the deals, right? Like so he's in the right seat, right? But it's just funny because I'm like, man, like we gotta like. I'm kind of that bridge or that whatever you want to call it between our staff and
well, I know. Yeah, Matt doesn't get just like me. I don't understand the complexity of when I'm pushing new deals through. I just look at the next deal like you get the brunt of the close is the easiest part, right?
Oh yeah. Then we got to go actually execute, right? So we got. We had our team down there this weekend, right? And we're kind of,
yeah, I know.
It's all
exciting, man. Well, good. Hey, Steve, thanks for your time, man. I appreciate it. Always great.
No, thank you for having me, and really appreciate you guys, and looking forward to seeing you again here soon.
Awesome.
See you, man.
Thanks, Steve.
Bye-bye.